Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Dotcom.
After listening to today's news, you'll know: first, US consumer spending surges as PCE inflation holds at 2.9%, paving the way for Federal Reserve rate cuts. We'll analyse why market confidence in rate cuts is high and how hidden inflation risks could trigger a sharp, volatile repricing. Second, the Buffett Indicator smashes a record 217%, far above the Dotcom bubble, signalling extreme market overvaluation. In this episode, we'll break down the contradiction between this record valuation and Buffett's own selling and what it signals about potential market fragility. Third, South Korea's birth rate collapses to a record low 0.72, threatening its economy and national security. We'll explore how this demographic crisis is forcing a pivot to technology and reliance on US security guarantees, reshaping South Korea's future. The American consumer just went on what one chief economist is calling a revenge spending spree, and it's clearing the runway for the Federal Reserve to cut interest rates. The latest report shows the Fed's preferred inflation gauge, the core PCE index, held steady at 2.9% annually. That stability, right in line with expectations, is the signal policymakers were waiting for. But let's peel back a layer here, because the headline number doesn't tell the full story. The key is the widening gap between goods and services. Goods inflation was almost zero, but services inflation, driven by things like housing and labour-intensive sectors, remains stubbornly high. This is what economists call sticky inflation. This is significant because it represents the challenging last mile in the fight against inflation, and it could force the Fed to be more cautious than the market currently expects. A while back, we noted that inflation could hover in the mid 2 to 3% range for longer than people like today's 2.9%, sits squarely in that band, reinforcing the last mile challenge. It suggests the widespread tariffs have had only a limited effect on consumer prices, a major surprise to many economists. As we mentioned a while back, one big reason is abroad. With China's factory gate prices in deflation, many exporters have been absorbing tariff costs to protect US market share, temporarily muting pass-through to American consumers. So what's really going on? This muted effect isn't because the tariffs are ineffective. It's more likely that many American companies are absorbing the extra cost by compressing their own profit margins and carefully managing their inventories. And here's the catch. This ability to absorb costs is finite. Once that capacity is exhausted, we could see a sudden surge in goods inflation. We previously analysed those second round effects and even saw CPI. Revisions that suggested earlier data understated tariff pressures. Billionaire investor Ken Griffin warned only about half the tariff impact had flowed through. Put differently, if China's producer prices stop falling and exporters can't keep eating those costs, that hidden inflation can surface quickly and catch a dovish market off guard. For Chinese exporters, this has meant a temporary buffer, but if US companies start passing these costs on, it could impact demand for Chinese goods down the line. But that's not the whole picture. The real turning point is in the consumer's wallet. Personal income rose 0.4% for the month, while consumer spending accelerated at a 0.6% pace. Both numbers beat estimates, showing a consumer that remains incredibly resilient. The source of this resilience is actually quite revealing. This spending is being supported almost entirely by income growth, not by dipping into savings. This balance is fragile. Any softening in the labour market could force consumers to make a sharp choice between cutting spending or draining their savings, a key indicator to watch for any potential economic slowdown. A while back, we talked about that 3% psychological threshold wearing on households and early signs of sentiment fatigue. So today's resilience is impressive, but it will be tested if inflation lingers near this zone. The quote of the day comes from an economist at FWD Bonds who said consumers literally hit it out of the park after hunkering down during the tariff rollout. This all leads directly to the Fed's next move. With inflation contained and the consumer strong, Fed officials are now indicating they see 2 more quarter percentage point rate reductions before the end of the year. Markets are already pricing in the change, with stock futures rising after the report. We previously highlighted a more hawkish counterpoint from Ken Griffin, only one more cut with the risk of a policy rate divergence if incoming data don't cooperate. Now, get this, the market is showing a high level of confidence, or what some might call complacency, in the Fed's plan to cut rates. Tools like the CME FedWatch tool show that traders are almost certain of future cuts. This creates an asymmetric risk. It makes markets very vulnerable to a sharp, volatile repricing if any single upcoming data point like next month's jobs or inflation report contradicts this smooth disinflation story. As we've discussed before, delayed tariff pass-through and sticky services could be the spoiler. So the key focal points to watch are the upcoming labour market reports and, of course, the next PCE inflation data. An unexpectedly strong report could cause stock market volatility and a spike in bond yields. The central conflict between tariff fears and economic reality has a clear winner for now: the resilient American consumer. This has flipped the script, paving the way for the Fed to continue its policy of monetary easing. But remember our earlier caution: if exporters stop absorbing costs or second-round tariff effects show up, that path could get bumpier in a hurry. Speaking of a market rally, it's pushed one legendary investor's favourite warning sign into uncharted territory. Warren Buffett once warned that when a key market indicator hits 200%, you are playing with fire. Today, that very indicator isn't just approaching that level, it just smashed through it, hitting an all-time high of 217%. The gauge, known as the Buffett Indicator, measures the total value of the US stock market against the nation's economic output. So the thing is, the indicator is calculated by dividing the total market capitalization of all US stocks by the gross national product, or GNP. Think of it as a price tag for the entire stock market compared to the size of the whole economy. A ratio above 100% historically suggests the market is overvalued. To put today's number in perspective, the indicator only neared 150% during the peak of the Dotcom bubble. The pandemic era rally in 2021 topped out at 190%. At 217%, the market is now in completely uncharted territory, with stock values expanding far faster than the US economy. This rally has been fueled by mega-cap technology companies ploughing billions into artificial intelligence and being rewarded with massive valuations. However, if you zoom out, you'll see another layer to this. This record high doesn't mean the entire market is in a bubble. It's all about concentration. The indicator's extreme level is primarily driven by the unprecedented valuations of a handful of AI-focused tech giants. This creates a unique risk. If a correction comes, it could be narrow but incredibly violent, especially for passive index funds that are heavily weighted towards these same few companies. And interestingly enough, this isn't just a US story, it's a global one. A big reason for these sky-high US valuations is a phenomenon investors call TINA, there is no alternative. Global capital is flooding into US tech stocks because of the perception that America has an unbeatable lead in artificial intelligence. Just look at Europe, where the market cap to GDP ratio is still below 100% and China's is around 70%. This makes the Buffett Indicator not just a measure of US valuation, but a gauge of global capital flows. The implication here is that if Europe or China were to launch a credible AI strategy that attracts investors, these capital flows could rapidly reverse, putting significant pressure on US stock prices, and it's not the only warning sign. The S&P 500's price to sales ratio recently climbed to an all-time high of 3.33, a level that eclipses both the dot-com peak and the post-COVID boom. Let's focus on this specific metric for a moment. The price to sales ratio is considered by many analysts to be a more direct danger signal than even the Buffett Indicator. Why? Because sales revenue is much harder to manipulate with accounting tricks than corporate earnings are. A record high P divided by S ratio means investors are paying more for every single dollar of a company's sales than at any other point in history. They are betting on a level of future growth that has no historical precedent. If that was just the appetizer, the main course is just being served. The real drama is what Buffett himself is doing. While the market soars on I hype, his firm, Berkshire Hathaway, has been a net seller of stocks for 11 consecutive quarters. He's not buying into this rally. His actions are in themselves a powerful real-time signal. He's building a fortress of cash, now totaling over $344 billion. This isn't just being cautious. It's a leading indicator from the world's most famous value investor that he sees a profound lack of attractive opportunities at current prices, signaling he believes risk is extremely elevated. Some argue the indicator is outdated, that a tech-driven economy justifies higher valuations. There's some logic to this argument. Proponents are saying that the indicator's denominator, GNP, was designed for an old school industrial economy and structurally undercounts the value of today's intangible heavy economy. Think about assets like intellectual property, brand equity, and software. These are massive value drivers for tech companies, but aren't fully captured in traditional economic output figures. So a permanently higher valuation plateau might be the new normal. The debate really boils down to whether we are correctly pricing in true innovation or simply ignoring a classic bubble signal. But the market is telling one story, and Warren Buffett's own actions are telling another. With his indicator now deep in territory he once called dangerous, his moves speak louder than any market rally. So what should we watch for next? The focal point remains the performance of those mega cap tech stocks. Their upcoming earnings reports will be critical. If they show any signs that their spectacular growth is slowing, it could challenge the very foundation of this rally. Also, keep an eye on policy announcements from Europe and economic data from China. Any significant moves in AI or a strong market recovery there could trigger a shift in global capital, impacting US, stocks, the dollar, and even bond yields as investors reevaluate where to find the best returns. Disclaimer, this content is for informational purposes only and not investment advice. Market data is volatile and subject to change. While US markets are riding high on AI optimism, another major economy is betting its entire future on technology for a much grimmer reason. South Korea's economy, one of the famed 4 Asian tigers, could begin to contract as early as 2041. The cause isn't a market crash or a trade war, but a demographic time bomb. The nation's birth rate has collapsed to one of the lowest in the world, recently hitting a record low of 0.72. For a population to remain stable, that number needs to be 2.1. At the current rate, for every 100 Koreans, the next generation will have only about 36 children, gutting the workforce and slowing growth to a crawl. This is where the situation takes a more complex turn. South Korea is in a desperate race against time, betting on technology to outrun its demographic destiny. The key question is whether investment in automation and AI can grow faster than its labour force shrinks. What's remarkable is that South Korea is already a world leader in this area. As of 2022, it had 1,012 industrial robots for every 10,000 employees. To give you some perspective, that's more than double the density of Germany or Japan. This makes South Korea a global test case for whether technology can truly overcome a demographic crisis and prevent a Japan-style lost decade of economic stagnation. Believe it or not, this isn't for a lack of trying. The government has thrown over $270 billion at the problem over 16 years, rolling out cash bonuses and support for new parents. They even considered exempting men from mandatory military service if they had 3 children. The result? One political economist bluntly stated, "I don't think there's any way that population policy can effectively raise fertility levels in South Korea in any appreciable way. The failure of South Korea's massive spending provides an expensive lesson for other countries facing similar issues, including China, Japan, and Italy." After all, research shows that in high-cost, high-competition societies, simply giving parents cash has a negligible impact on birth rates. The real barriers are structural, the high costs of housing and education. We're seeing countries like Sweden and Norway, which focus on comprehensive support like subsidised childcare and long parental leave, maintain much healthier fertility rates. The takeaway for policymakers is that you can't just throw money at the problem. You have to fix the underlying system that makes raising children so difficult. This isn't just a future problem, it's a crisis happening now. The national pension system is already under immense strain, forcing reforms where younger generations will pay higher premiums for lower benefits. The immediate consequence is that South Korea's national pension fund is now projected to start running a deficit in 2041 and could be completely depleted by 2055. This isn't just a domestic issue. A full-blown pension crisis could trigger a run on the Korean won, force massive tax hikes on an already shrinking workforce, and damage the country's international credit rating, making it more expensive for the government and companies to borrow money. What really brought this to a head, though, are the implications for national security. South Korea is still formally at war with North Korea, yet its active military has shrunk by 20% in recent years to about 450,000 troops. By contrast, North Korea maintains one of the world's largest standing armies with around 1.23 million personnel. A little discussed consequence is that this shrinking draft pool is fundamentally changing South Korea's defense strategy. It's eroding its conventional deterrence, forcing a strategic pivot. The country now has to rely more heavily on 2 things: unproven high-tech weaponry like autonomous systems, and its security guarantees from the United States. This shift increases regional instability because it raises the odds of a miscalculation, and it also gives the US greater leverage over Seoul's foreign and defense policies. So, what's next? One of the most direct but politically explosive solutions is immigration. For a historically homogeneous society, this is a major challenge. However, the economic reality is becoming undeniable, forcing a quiet but necessary pivot to accept more foreign labour to prevent a severe economic contraction. This is a key focal point to watch, as it will test the limits of Korean society and impact labour flows from across Asia. Despite the dire numbers, some analysts caution against betting against the country. They point to South Korea's miraculous rise from the ashes of the Korean War, a feat few would have predicted. This is a new kind of challenge. But as one expert noted, the record of the past suggests it's not smart money to bet against the South Korean people.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.